In Learning Objective 16-6, we're going to look at different advantages and disadvantages of equity financing. When I say equity financing, that generally means for a corporation that they're selling stock in some manner. When you hear the word IPO from a corporation, that's referring to the initial public offering of stock, and that's always sold on the primary market. The IPO after that, you can never use it again. It would be called just a offering of stock for sale. Investors buy and sell stock, of course, on a daily time frame on the secondary market. Finally, all your exchange of stock equity is done through either over-the-counter or through a securities and exchange outfit. Common stock, as you may remember from earlier chapters, is owned by people that can vote on the corporate directors, and a lot of times, if they're going to have a change, say to the corporate charter, it would only be your common stockholders that could vote on that. If you have preferred stock, know that you're not going to get to vote on anything. However, if there happens to be a shortage of cash to use as dividends, the reason you bought preferred stock, you'll be getting your dividends before and maybe instead of common stockholders getting dividends. If you're a corporation, another source of financing for equity type is your retained earnings. That retained earnings on your balance sheet is nothing but a corporate savings account. Monies that you have not been handing out from dividends that was in your profit for each year goes into the retained earnings account. Should you want to do some financing equity-like, you can actually borrow from your own corporation. You still have to fill out paperwork, but you can actually borrow from the retained earnings and pay it back. You're going to be paying whatever the IRS calls the nominal rate of interest that year. Finally, venture capital. You hear about it all the time, but you can go to present your idea to venture capitalists, individuals sometimes, or a group, or a certain fund, and they'll consider loaning you money. Usually if they feel like you have a fairly short-term chance of them making a large gain, they'll consider loaning you money. If it looks like it's too long of a term, your venture capital people are not going to be very interested. Another source is called angel investors, and I've used them. They can provide money to start or expand a business. In that case, the angel investor has a lot less stringent rules and regulations. In fact, they can be quite simple. It's like your uncle loaning you the money, but you do still sign a note. Finally, they can do what they call a private placement of stocks. I can set up some private stock to sell. I'm going to sell it only to a certain insurance company or another corporation and use corporate, what they call commercial paper.